SD Bullion.
This is the Doc with SD Weekly Metals and Markets Review. Joining me again tonight is Eric Dubin. Quite a week here in the metals.
Indeed it was. It seems like every single day something's coming hitting the news front and things get faster and faster. But before we dive into that, hey, I heard that you had a run-in with a haircut this week.
I had a haircut this evening. Thankfully, my hair was the only thing that was shaved. I didn't lose any of my deposits, but we were just Eric and I were just discussing before we began the broadcast here. We recorded just a couple hours too early last weekend on Friday. Really monumental news. Obviously, most of our listeners are aware out of Cyprus last Friday evening, so we'll get to that in the show, but let's start with a quick recap of the metals. Silver closed tonight, the 22nd, at 28.76, basically unchanged for the week. Gold closed at 16.09, up approximately 25 for the week, in back above 1600. A little bit of caution is needed, especially early next week with options expiration on Monday. But what's your take on the metals, Eric? It looks like gold is receiving a little bit stronger of a bid right here throughout the week, probably due to Cyprus.
Yeah, that seems definitely part of the mix that's pushing gold relative to silver higher. And in fact, if our listeners pull up a chart of like the last 2 months or so, it's pretty clear that silver has been under a lot more pressure when people are thinking, hey, the economy worldwide may slow down if all the banking systems are conceivably coming under pressure again. When folks run for the exits in the banking system, they're definitely looking towards gold as being a safe haven. So we see an incremental increase in the bid on gold. And you can look at that even in, say, the last 48 hours. This price of silver got whacked today, even though it was strong yesterday, and it looked like it was probably more likely a short covering than anything else. But going into Friday, the cartel forces were probably looking at that 1620 line on gold and saying that matches or almost exactly matches the high back on February 26th. And every time gold tries to get past that level, traders will be looking at that and wondering if they should get serious about going long gold, if gold will be able to quote-unquote prove itself, so to speak. So it's no surprise that 1620 was a line in the sand when we were just about ready to test that today with all the craziness going on in Cyprus and with everyone expecting increased risk in the banking system. Lo and behold, the cartel shows up and pushes gold down.
And I have to interject here a second, Eric. If there's anyone out here that's remaining a skeptic as far as the intervention and manipulations of the Western central banks, I think today it really should put your mind to rest of understanding what's going on. I mean, we have Cyprus situation is completely unresolved going into the weekend. What rational investor is selling gold into today's market close with all the uncertainty in Cyprus this weekend?
Sure. I mean, you can look at it in multiple ways as a trader. You can say to yourself, well, okay, things are uncertain, so let's say, hypothetically, Cyprus fails to get a bailout and their banking system falls apart. They leave the euro. The euro begins to be questioned more and more, and is that the kind of outcome that somebody as a rational economic actor would say to themselves, gee, worldwide, risk is lowering? Well, of course not. It points to a systemic type of increase in risk that would argue in favor of owning gold. Even if a bailout was approved, you're talking about more money printing, which in turn means that the system is gearing up to deal with these ongoing bailouts and further money printing and further expansion on the balance sheets of all the central banks, et cetera, et cetera. And what does that result in? More inflation, which means that's a positive for gold and silver. So, any way one slices it, as a rational economic actor putting on their hat as a trader or an investor normally in a world that operates on what would be considered normal economic precepts, gold would not be falling in advance of this weekend. So, it's a perfect case in point where you do the actions of the powers that be that are trying to manage things around the edges. And, it's not like one needs to make the argument that management happens on a daily basis. And many people look at that whole argument about management of gold and silver and say, well, you guys are just discounting any kind of decline and chalking it up to the powers that be, rather than trying to find economic answers. But when you look at examples like today's trading, it makes no intuitive sense whatsoever to somebody who would consider the issues in terms of normal economics.
We move on to that big story in Cyprus. The latest news, the Cypriot banks are going to be closed at least through Tuesday, as banks have a holiday on Monday. The big news early this morning, ECB has enacted capital control. So the ECB, no Cypriot elected any of the ECB officials, but they have decided to supersede the Cypriot parliament and enact capital controls, which really they really don't have any choice. If the Cypriot banks ever are reopened, the minute they are, they're going to have a massive bank run. But the ECB has frozen saving accounts indefinitely, even when the banks reopen. They've also reduced ATM withdrawal amounts. So Eric, really I take it that this is kind of Lehman Brothers and MF Global all rolled up into one. It's kind of an MF Global type grab at the depositors, putting them in front of like the bondholders and people who should have been more first in line to receive haircuts. And it also seems to be a Lehman Brothers type event that could be a big mistake by the banking system that could result in just a massive financial collapse and get the snowball rolling.
Right. Well, I'd preface my comments by saying that I think that there really is no way that anybody can know with certainty what will the world look like, say, this time next week. That said, there are certain things that make this a little bit different than, say, the Lehman Brothers, Bear Stearns analogy that a lot of people are kicking around right now, and that's primarily that those institutions had counterparties all over the place with respect to derivative relationships, whereas this primary banking problem in Cyprus is tied up in all kinds of other investments, of course. Yes, for example, they took it on the chin when it comes to the huge positions they had in Greek bonds, and then the Greek crisis made them basically become insolvent. But the nature of linkages in the derivatives market doesn't seem to be as extensive nor as insane as something like what was going on in Lehman Brothers. It's quite possible that this is the kind of situation that could be put out as a fire if the ECB chooses to just get serious and basically come to some kind of an agreement where they're willing to turn on the printing presses and go for it. And your guess is as good as mine as to whether or not that's going to happen. I mean, the latest seems to be that the ECB has gotten Cyprus back on its back after having returned from Russia when getting a no, basically, from Russia in terms of on any kind of offer of assistance. In the very least, you got to wonder what's going to happen in Spain, what's going to happen in Portugal. What are average citizens in these nations going to do when it comes to their level of confidence in the banking system? They can put capital controls on and hope to slow the crisis such that it could possibly be healed in time. But I think that this, in the very least, we can say is a mortal blow to overall confidence. And over the course of the last 5 years of this rolling crisis, confidence has continued to be diluted. That, I think, is one of the biggest factors behind what will drive the long-term engines of the gold and silver bull market. In the very least, I think that we can conclude that and hope for the best and hope that things don't spin out of control over the next 5 days, but you never know.
And I think a lot of the market was really looking for the potential of Spain and Portugal to have bank runs this week, and we're surprised that there haven't yet. And I really think we do have the potential for bank runs, and I'd look for them to begin more in Greece or Italy if they do. If final haircuts are agreed to and Cypriot depositors are actually have their wealth taxed or confiscated, I think that's going to be the potential for that to begin. I'm not sure that even the Southern Euro zones, their citizens are going to wake up right now while it's just in discussion. So we'll definitely have to keep an eye on that, whether we do start to see bank runs in, say, Greece, Italy, or Spain in the next week, if and when the final deals are announced and the Cypriots receive their haircuts. Well, let's move on a little bit from the Cyprus crisis and discuss Jim Sinclair's meeting in New York this week. Sinclair spent a lot of his time at his meeting discussing the Cyprus situation and how it's such a big, major policy misstep for the IMF and the ECB, in that essentially they're undoing trillions of dollars worth of printing work by the Bank of England, the Fed, and Bernanke, and are attempting to shift their policy from quantitative easing to bail-in wealth taxation. So what are your thoughts on, do you think Cyprus was just a major policy misstep for the IMF and the ECB?
It seems more along the lines of something that they were trying to test the waters with. Bail-in goes against the whole fundamental principle of the sacrosanct nature of a depositor's loan to a bank. And yes, indeed, when somebody deposits money in our current fiat credit-based system, you are making a loan to the bank. So they're playing footsie with the whole concept of what is and what is not an unsecured creditor to a bank. You know, for the better part of 70-plus years since the Great Depression and the whole concept of FDIC in the United States and then replicated thereafter across the world, it's always been assumed that you're going to want to make sure that the little guy in particular is protected and that there's no fear of the banking system or a specific bank has not made such reckless actions with its balance sheet that it can't cover a 5% or however many percentage-based run of its depositors on its doors. And the fact that they're willing to even consider playing risky games with that fundamental concept of capitalism just goes to show how far crony capitalism has taken over the Western economic system. And we're in a state now where the financial system has grown to, at its peak in 2005 in the United States, it was like 40% of the economy. And anytime you have that kind of a lopsided concentration of wealth, it's no surprise to see the politicians being completely taken over with those interests. So to answer your question point blank, I don't really know whether or not in some closed, dark room people smoking cigars and deciding, hey, why don't we just see if we can get away with this as a test, and then thereafter, if we need to do a bailout in Spain, which they will, the situation is not resolved, they say to themselves, perhaps maybe we can make the depositors in Spanish banks partially responsible for the mess rather than just sticking it strictly to the printing option. And incidentally, there definitely is a political force being manifest in the ECB with respect to German citizens and to a lesser extent even in Finland and Dutch citizens that are extremely skeptical of money printing because they know that that's basically a delayed form of taxation on them, and when it comes to their pocketbook and their spending, it's the same thing as a bank deposit haircut,
right.
Because they'll lose their money one way or the other. And as far as the bankers are concerned, they only want to make sure that it's not the bondholders of the banking institutions or the shareholders holding the equity of the banks that get hosed. They want to hose the average citizen and or the bank customer. What it shows the advanced decay in our global monetary system, and that's really the take-home point. And that really is the impetus behind the calls that we hear from people who have studied monetary history for the better part of their lives. Folks like James Turk and others who say, you just have to be your own central bank. You have to get out of these banks because the central banks and the banks are out to get you one way or another to cover the losses that they made.
If there's any doubt in your mind before as to the need to be your own central bank, I think the events of this past week should have removed that doubt whatsoever. And kind of to support that hypothesis that the events in Cyprus just kind of being a test run to see what they can get away with, Spain has reportedly just changed its constitutional rules to allow depositor haircuts. New Zealand is attempting to pass legislation that depositors would see haircuts in all future bank failures. And then even this afternoon, news broke that Italy is pursuing the possibility of depositor haircuts. It definitely looks like they're attempting to go that route. I think it's going to be a big mistake, and it's going to trigger a loss of confidence, which is really the only thing holding the Western financial system up by threads anymore. But getting back to Sinclair's meeting in New York City, he kind of made a firestorm with his comments on silver. For the readers who haven't, or for the listeners who haven't heard or read his comments, on Wednesday at his meeting, Sinclair predicted that gold will reach at least around $5,000 an ounce, and he sees silver passing triple digits, passing 100. It's not going to reach 500. He said it would have an orgasmic-like rally and a subsequent crash, and that the comment he made that really kind of lit a fire under silver bugs is that he said that silver was not a monetary metal. So I think you and I disagree with Sinclair a little bit on that. So what are your takes on that comment by Sinclair?
Yeah, and I mean, it really does boil down to his view of silver as not being a monetary metal. And his thesis for the coming months and years ahead is that essentially gold is moving back into the center stage of the monetary system worldwide, which is pretty clear that that's happening. And when he looks to silver, he sees it as the poor man's gold and secondary when it comes to assets that can be, for instance, considered by the Bank of International Settlements as part of the balance sheet of the reserves of central banks and banks in general. So it's really not terribly surprising that he has the views that he has. I think it's more something that is reflective on the amount of time that he's spent in his entire life focusing on gold vis-a-vis what is, relative to that huge swath of experience, very minimal amount of time actually rolling up his sleeves and paying attention to what are the true fundamentals in the silver market. And that's not to disparage him at all, because when it comes to his understanding of gold, he is truly in a class unto himself and a class act as well, I'd go as far as to say. But I just frankly don't think he understands silver as well as he could. Time will prove who's right, but I suspect that if gold has an underpinning at 5,000 or higher via central banks using a new worldwide trading system, there's no particular reason why the relative ratio pricing of silver would not at least find some kind of stickiness, like like James Sinclair's magnets of old, where he would show on his website magnets pulling gold bars of 1,650 upwards, and other price targets of 2,025 if memory serves, and so on. That whole pulling forward of gold is definitely going to pull silver forward, because people are going to have to shift the price of real assets upwards across the board. I mean, to argue that silver will crash would be analogous to say that gasoline would go to $10 a gallon after gold went to 5,000, and then all of a sudden, just because it's not part of the monetary system of the international banking system, gasoline would fall back down to, say, $5. I mean, I'm obviously just picking numbers off the top of my head, but I'm trying to show the relative dynamics of a hard asset that provides utility and is a form of stored labor. People look at precious metals as a form of stored labor. And to some extent, you can see relative valuations of the commodities in a similar sense. And so it doesn't make a lot of intuitive sense, never mind the fact that silver and gold over the course of 5,000+ years have had a pretty decent relationship of trading within a pretty tight band of 20 ounces of silver to an ounce of gold, all the way down to about 10, and shifting in between that band. So as far as I'm concerned, I think he's wrong.
In all fairness to Sinclair, when he's asked about silver, he often defers to folks like Eric Sprott or others who study the silver market more than he does, and he says that he's really not the expert on silver.
And he claims to have a mercantile sense of the gold market, but anything but when it comes to the silver market. So, I mean, the guy is speaking from both his book, but being very honest about it.
And I think one other thing that people seem to be getting so emotional about his thoughts and his predictions for silver, but he is still a proponent of owning both gold and silver. He actually said on Wednesday that if you have silver, he told people not to sell it to exchange for gold, to hold what you have. And I think another point that even if his view does turn out to be correct, for those who are nimble and able to play it right, really the best play would be to hold silver through that spike and then trade out for gold or for other physical assets, because even Sinclair has admitted that silver is likely to have a greater percentage rise than gold will.
Yep, I can remember back 5 years ago or so when he had his first major public meeting about gold in New York, and he talked with the then investor relations specialist of Silvercorp, and she grilled him about silver and his views, and it's the same old story. He's basically been in cruise control when it comes to trying to understand more about the silver market, and has left that domain to people, like David Morgan and James Turk and others who have spent a lot more time in it than he has.
Well, let's try to wrap up here. We'd want to discuss the FOMC meeting as well. Really the same old story this week again. QE is going to continue for the indefinite future. Really no surprise in the wake of the situation in Cyprus. There wasn't quite as much bearish mope as we'd had over the last, say, few weeks or months from the Fed. We had really Bernanke speaking more about a slow, gradual recovery, which it seems to be like Bernanke's been speaking about slow recovery ever since 2009. It's been, 4 years now that we've had green shoots in a recovery. When was it? 2009 or 2010 that the green shoots articles are written, and I
think he coined the term in 2009 as far as green shoots.
And we still have the same green shoots, so they haven't grown very much in 4
Right,
years.
yeah. Well, there's been also this pattern too, where it tends to be that in the first part of any given year in the last 5, we see somewhat of a stronger economy and sentiment gets stirred up a little bit, and then all of a sudden in the second half, or roughly just later in the year, things begin to slow down again. And I think that we're seeing the same pattern right now. There was a concerted effort with the launch of QE3 and then QE 3.5 or 4 or whatever the heck you'd want to call it, moving between last fall and, say, last February. And then all of the jawboning when it came to the precious metals sector, starting with Goldman Sachs' call back in the fall that gold would top out in 2013 based on a strong economy and people more willing to have faith in the system. And here we are, Cyprus falling apart, and the same cycle is beginning to rear its head again. I mean, just today it was reported that somebody had took out this gigantic put trade on the euro versus the dollar cross for the next, I think it was for the next closing, so next month. But it was a huge trade. It was like $900 million or something like that. So that the level of angst in the whole financial system is beginning to ratchet up, which does wonders when it comes to Bernanke in his effort to try to maintain consumer confidence in the 70% of the U.S. economy that's predicated on consumption and nothing else moving forward. And that really has been the core of what has pushed the stock market higher, along with the money, of course, the money printing and the fact that it flows through the banking system into the stock market. But for the last couple of months, people have been a little bit more optimistic about the future, and investment managers in turn, and the whole conventional financial system has been gearing up towards this whole idea of financial assets moving forward, people pulling money out of bonds because they get nothing in return, and this whole recovery of the economy worldwide taking hold. But the thesis has a lot of holes in it, and I think we're going to see the same pattern that we've seen in the last couple of years, where as we move further into this year, things will begin to slow down a lot. From there, the Fed and other central banks will continue to press heavily on the accelerator when it comes to money printing. The Fed doesn't also at the same time have much room for maneuver when it comes to their so-called exit strategy. I mean, even at this point, the trial balloons are coming out where they're talking about not selling any of the bonds or mortgage-backed securities on their balance sheet, just letting them roll off as they expire. And that probably will be what happens. So with that much liquidity not ultimately locked up and sopped up in the banks or the Fed's balance sheet, it'll slowly but surely work its way into the economy and create inflation. So, stagflation is what we have to look forward to in the second half of this year. And I think as more people come to terms with that reality, it'll drive a renewed look at the purchase of gold and silver.
All right. Well, I suspect that in next week's show, we're going to have quite a bit to talk about, just like we did tonight. The world's changed, as we were talking about before the show, since last Friday night. That should do it for the SD Weekly Metals and Markets today, Friday the 22nd. Tune in next week, and maybe the results are still in progress. The bank holiday of Cyprus.
If the World War III hasn't begun.
All right. Thanks for joining us again, Eric.
Nice chatting with you.